Five.
Okay.
Happy Friday! It's Finance Friday. Hello, everyone. We hope you are having an awesome holiday season. Check us out on Twitter. Follow us on Twitter at Nova Wealth Management, MGMT. Hey, Johnny. Thanks for joining, being consistent. Hey, RT. This was a suggestion, actually, from RT. And check out our YouTube channel. Subscribe to our YouTube channel. We do super quick 90-second, 2-minute videos on YouTube with information.
Like us on Facebook.
Like us on Facebook. We have actually a podcast that there's also a video version of the podcast. It's the Nova Wealth Show, and it's on the Wooditch Network. So check out the Wooditch Network show and the podcast, the Nova Wealth Show.
How do you get to the Wooditch Network?
TheWooditchNetwork.com.
Okay.
It's just like it sounds. WOOD-itch.
Okay.
So, in the spirit of the holidays, we all love to talk about giving. And just in general, charitable giving is obviously a great practice to do. A lot of us do it already, but some of you have requested that we explain what are the tax advantages of charitable giving. Since we're coming towards the end of the year, you only have about 3 weeks left to get in your retirement contributions, your charitable contributions, because once the end of the year passes, your tax bill for 2017 is done, is finalized. So we want to talk about 5 strategies. We were just arguing if it's 4 or 5. I think it's technically 5.
We'll try to do 4.
Because I see I have 2 twos
okay.
here. So it's 5 ways to give to your favorite charity, and we'll talk about the tax benefits of each. Okay, and you only have until the end of the year to do it. So that's why we need to talk about it now. All right, so the first one, why don't you go ahead and just kind of briefly...
Okay, the first one is to gift actual stocks that you have capital gains in.
Right.
Because then you can take a tax deduction for the value of the stocks, and then you get to avoid paying the capital gains of those appreciated stocks.
And although we all are probably okay with paying gains tax, so when you make money on an investment, you owe what is called capital gains tax. I know that's very basic, but let's review that for a second. So not everybody knows that. So if you make money on an investment, whatever amount of money you made, a portion of that you're going to owe in tax. Yeah. So when you take an asset that's appreciated, a stock that is appreciated, or it could be anything really.
Yes.
It could be
investment property,
stock, ETFs, mutual funds.
LLPs,
Yeah,
anything.
It could be anything. So you give that to charity, you now not only, like she said, avoided those capital gains tax, but you get a tax deduction for the whole value to the charity.
It's important you know that you have to gift the asset. You can't sell it and then give them the money.
Great
you have to
point.
actually give them the stock, give them the investment property.
So you transfer it. There's a process on that. If you have questions on that, please call us. And we just had a few people join. So we're just talking about different ways to save on taxes by giving to our favorite charities that we're probably already giving to. But if you give appreciated assets, just like Tamara said, you have to transfer that in kind. Yeah, don't sell it first, because then you're going to pay.
Then you're paying the tax.
Great point. Okay, so hopefully no questions on that. So you can move those assets to a charity, avoid the capital gains tax, and get your charitable deduction. Okay, the next one is really simple. So there's donor advised funds, they call them DAF accounts, that really, this is if you're in a pinch at the year end and
you don't have time to transfer assets.
Right. You don't have time to really...
Because it's a timely process.
Right. And you don't necessarily, let's say you want to give to a charity, you want to do a certain grant, but you don't have time to work out all the details of the grant and all this stuff, so you can give money or securities to a DAF account, a donor advised fund. And that way, the money is moved immediately. A lot of charities actually already have them set up.
Right.
So you can do this with just a couple clicks.
of forms.
And the technology makes it a lot easier too. And then you can establish later how much you want to grant, or what are the terms of the grant to the charity, or what charities you want to give to. It doesn't all have to go to one charity. So like I know some of the bigger firms, like I know Fidelity, TD, they all have their own that you can put money into and then determine where the money actually goes, like later. You don't have to do that right this second. So it's just more of a convenience thing, but again, a donor advised fund, DAF funds, and every firm has their own title, so just kind of look up if you can establish one even yourself, and then determine how those funds are going to get allocated later. Okay, next.
Roth conversion.
Yeah, why don't you go over that too?
So you can actually make, if you're going to convert a traditional IRA,
or if you already have this year.
Right.
If you've already converted funds this year.
And
you probably should talk about that for a second.
The conversion?
Like what it is. Some people are probably thinking, what are you talking about?
Well, a traditional IRA comes with, it's tax deferred. So you actually pull the money directly out of your paycheck and you make contributions. And you don't
before tax.
You don't pay tax on that money. It goes into an IRA, and it's before tax money, and it grows tax deferred, and it stays in there until you're at least 59 and a half. And when you pull that money out, it's fully taxed to you as ordinary income. A Roth IRA is with after-tax dollar. So you actually get your paycheck, you've already paid all your taxes, and you send money into a Roth IRA. So then that grows tax deferred, and when you pull it out, you don't have to pay any tax on the money that's there because you already paid the income tax on it once, or any tax on the growth.
Right, and I want to add that at 70 and a half on the traditional IRA, long time no see, on the traditional IRA, you will have to pull out money. At 70 and a half, you will have no choice, even if you don't need the income. The IRS hasn't gotten their tax money on that yet.
And they want it.
And they want it.
And on a Roth, you don't.
And on a Roth, you don't have to pull out money at 70 and a half. So, what I was getting at is some people like to convert their assets if they've been putting money into a 401k. And they like to convert it from the traditional bucket that we said is taxed later in life and you have to pull out money at 70 and move it to a Roth IRA. You owe taxes on that transaction. So when you move money from the traditional to the Roth, now I just want to mention really quick that if you are in a 401k with a company and you have two different options, you have a traditional option and you have a 401k option, and maybe you watch one of our Finance Fridays and you decide, oh, you know what, I should be doing Roth, I should not be doing, hey Paul, I should not be doing traditional, and you make that switch, that's not what we're talking about. That's not what you're going to owe taxes on. That's just you switching your every 2 week or however often you get paid, your type.
Right.
So when you get paid and your money goes into the 401k, you're just telling the system, I no longer want to put money into the traditional, now I want to put money in Roth. That is not a conversion, okay?
A conversion is when you actually take dollars that are already in the IRA or 401k, pull them out, pay the tax on them, put them into the Roth.
Correct.
And now they grow tax deferred and they come out tax free.
Correct. So now getting back to charitable giving, how this relates to giving to charities, right?
I got lost. I forgot what we were talking about.
Right? Talking about giving, okay? We're just trying to give a little backstory because people are like, we start talking about conversions and people are like, what are conversions? Why does that apply to me? So I just want to make sure we define what we're even talking about. But, so, giving to charity is a way to offset those taxes. So your favorite charities, whatever you're probably already giving to, if you are going to convert some money and you're going to owe taxes, talk to your accountant if you're not sure, or call us if you're not sure. So if you're moving money from a traditional to a Roth and you're going to owe taxes, if you contribute to a charity, that offsets those taxes. So this is a huge way before the end of the year that you can very quickly, if you're in a panic now saying, oh my gosh, I converted some assets this year, I'm going to owe tax on that? If nobody has told you that, yes, you will owe tax, and giving to charity can change that. Could change
some of it, maybe not all of it.
Right.
But it's worth a discussion.
We're not giving recommendations here. Everybody's different, but
if
please
you're
at least check it out.
If you're going to have a big tax bill, it's worth a discussion whether it would be beneficial to give it to a charity, because then you're not giving it to the IRS, and maybe you're benefiting some people that you'd really like to help.
Exactly, and then maybe you can give even more money, you know? So we want to get the most out of, obviously, our giving that we're already doing. We want to give the most, okay? So next, donating complex assets. So we talked a little bit about
appreciated stock.
We talked about stock, right? But if there's an asset that you have, an investment that you have, that is just something that you don't understand, you know, maybe you've experienced this, that you get a statement and you're like, I have no idea what I have. It's irritating. I don't understand it. It goes up and down. If you really don't understand what you have, you know, talk to your tax accountant about if you're going to give to charity, instead of maybe just cutting the check right from your checking account, give to get. Very good, Paul. You're listening. You're paying attention. So you can take that asset that you don't understand, that maybe it's just
too
better
much
off.
work. It's
Too much work.
A hassle.
Maybe it causes you a tax hassle if you get a K1. Any of you out there, we're not going to take time today to explain a K1, but they're always delayed. If you get K1s, you might have this annoying asset. If you give that to charity, even if it's a little bit more than what you wanted to give, it's a way to simplify your portfolio and give.
I think the important thing here is that people understand you don't have to just give stocks, bonds, things you understand that it's all asset types.
Right. There's a glare on your head. You scoot towards me. There we go.
So I think that's what you were trying to say here, is that it's not, you don't have to do just, the easy stocks, bonds, those things on statements. The more complex assets can be gifted also.
Right. And so investment property, you mentioned earlier, I would put that under this complex, category because I know, so I'm on the board of the Parkinson Association. I know there's a lot of people that when you have investment property, there's a lot of work that goes into that, and you don't, your time and energy, that works too, RT. We'll talk about, but you don't get a tax deduction for that. But of course, that's great. You want to feel good. That's why people donate, of course. So you get the best of both worlds. We just want to make sure you're aware of both options. But so if you have an investment property and maybe you have different renters, or maybe there's been repairs, or maybe
you're going to need large repairs and you don't have the time or energy to deal with the sale, or
right, or maybe it's in your estate planning that you need to get it out of your estate or whatever. Consider giving that to charity. I know it's a substantial amount, but take a look at your overall estate plan. Take a look at your overall tax planning. This is you're working with your professionals, but this is a way, especially if the property has appreciated, right? So you avoid the capital gains tax and you get the tax deduction for giving to charity.
Right.
So it's kind of everybody wins. So that's why we're really doing this. We want you to know that there's obviously a lot of our followers giving to charity, but there's other options than you have to just cut a check. And even though it may be more than what you're planning, if you take a step back and look at the overall benefits, it might be exactly what you've been looking for in your overall financial well-being too. Right. So it's a way that everybody wins. How do charity auction deductions work? Charity auction deductions. You mean like going to, Paul, elaborate on that a little bit. You mean like actually going to a physical auction and then it's for the benefit of charity? Is that what you mean? Or you mean just going to a general auction and that specific piece? Elaborate on that a little bit. Anyway, he's going to type that up a little bit. But as he's asking that question, I want to try to answer that question. Is that an accountant question? A lot of this can all be, I want to say that all of this should probably be run by your accountant because we don't know everybody's individual situation. But in general, this is what I'll say about charity auctions. So, okay, good. So if it's an auction for the benefit of a charity, then whatever usually the appraised value of that item will be what your charitable deduction is. Okay, so if you bid on that item, so when we were at a charitable event the other night and we bid on those items, I know I won some items at the charity auction. So whatever the valued amount, that's why they always say valued at. So they give you a value. If it's a trip, valued at. And so then you can talk about to your accountant if you get that value, if it's a specific art piece, or if it's actually like a vacation, if you're just going to get what you paid, what you actually gave to the charity. So usually the answer is going to be what you wrote the check for to the charity. But if it was an asset, talk about getting the appraised value. And then if you're the one gifting the asset, that's where it's different from the auction piece. So if you're the one gifting the asset, you'll get the appraised value. As far as we know, we don't specialize that in anything. I just want to send out that disclosure. But just from kind of what we've seen, I guess. Right. From what we know. So the last one is really important. So I hope a lot of you stay tuned in or at least get this far because this is huge. This just changed in
2015, was it?
2015. Okay. I think you're right. So there was a way to do it since 2005, but I think in 2015 they made it super easy and official. So remember when we just talked about on traditional IRA money or 401k money, at 70 and a half, you have to start pulling out funds.
It's called your required minimum distribution.
Required minimum distribution, or RMD for short. Okay? You owe taxes on that, and you have to pull that out. If you don't, it's a 50% penalty if you don't pull out your RMD. 50% of the RMD amount. right?
Or whatever
Not
you
of the
didn't-
account value,
whatever you
but
didn't
whatever
take.
whatever you didn't take.
Taxed at
Hopefully you guys can
ordinary
still hear.
income levels.
Yeah, so it's ordinary income, regular income tax. Hey, Heather, thanks for joining. So regular income tax rates for the required minimum distribution. So now you can do what they call a QCD,
Yes.
qualified charitable
Deduction.
or distribution.
Distribution,
yeah. And if you pull out the money directly from your IRA and you get that custodian, whoever has the money, whoever's holding the money, to send it directly to the charity, you can avoid the income taxes on your required minimum distributions. This is huge. So even if you are not over the age of 70, if you know someone that's taking these distributions or you're helping someone, even some accountants that we know didn't know this, okay? So if you're an accountant, if you're a professional and you didn't know this, you can take money out of your IRA. If you're over 70 and you have to take money out of your IRA, it really works. But if you want to take money out of your IRA to give to charity, you can, and it wouldn't be taxable.
Right.
If
This is also important if that RMD is going to push you into the next tax bracket.
Right.
So,
talk to your accountant about that. What marginal tax bracket are you in?
Right.
Because if you can avoid that, and you can even take a part of your required minimum distribution to avoid going into that next bracket.
Tax bracket, yes.
Give the money to charity so you feel good about giving. You're doing a good thing, that they need the money. Split it up among your favorite charities, okay? And you avoid the tax. So everybody wins. Again, there's so many ways to give to charity. So if you're one of those people that's always wanted to give to charity, but maybe you just don't have the money, or you're wondering, maybe I don't have the means, or how much do I give? Take a look at your assets, take a look at your tax situation, talk to your accountant, because you may be able to find a charitable giving strategy that not only, of course, benefits the charity, that's why we do it, but
doesn't cost you.
Doesn't cost you and actually helps you too. So that might determine your amount as well. St. Jude's, great charity. Yep, I've given a lot of money to them. Great charity. If you're tithing, if you give to a church, so Yolati from Living Waters, a lot of you know that I go to Living Waters, so that's another way you can give to your church. Churches, any not-for-profit, so churches qualify. I'm thinking, so charities, you're alum, if you're an alumni, and you give to school. So anything that would qualify for the charitable deduction actually would eliminate the tax on an IRA distribution. Now, exactly what you said before about before selling the stock, don't sell the stock first.
No.
Don't withdraw the money first and then give to the charity.
Directly to the charity.
Okay, then you may, if you don't itemize, you may not get that deduction.
Right.
Okay, so there's a way, custodians are very aware of this, and a custodian, again, is just the people holding your assets. If you notify them, there's a form that they will allow you to cut a check directly from your IRA assets or your 401k. I don't know if you can do it in the 401k. I spoke too soon. I think it has to be IRA.
It has to be IRA.
IRA
it
or
can't be
SEP.
simple or SEP. Remember?
Well, you have to move it. It
To
can
a
be, but you
traditional.
have to move it to the IRA first. So there's
Right.
like an additional step. So it can be. You just have to. There's an additional step.
Right.
But
Can't
then
be employer-sponsored plans. They have to go into a traditional IRA
first, and then it can go to
the charity.
and avoid that tax on withdrawing from your retirement money.
Right.
So okay, we went over a lot. Let's just summarize real quick. Do you want to just try to summarize real quick, or you want me to?
Go ahead.
Okay. So first one, giving to charity. First of all, we all love to give to charity, but there's 5 ways that you can give to charity that might help you determine your amount and how you give. Okay. So give appreciated stocks or any investments that you might owe gains tax on. Okay, so if it gained money, if it made you money, you're going to owe tax if you sell that. Instead of doing that, gift the whole appreciated asset, or actually even a portion of it, to a charity. You'll avoid the capital gains tax, and you'll get a charitable contribution tax credit. Okay, so establish a donor-advised fund. This was just a super quick, easy way that you, with a few clicks of a button, possibly a form, but I think most of it's automated nowadays, that you can move money into a donor fund and give to several charities. So this is really for the end of the year crunch time that we're talking about, that you don't exactly know which charities you want to give to and how much, or maybe you want to talk about a grant and you don't have time to figure out all those details. Move it into the donor-advised fund. You get the deduction immediately, but then you can determine the right way to give to charity. Hey, Courtney, how are you? Then you can determine over time. It gives you time to determine the right way to give to your charity, okay? We talked about Roth conversions. If you're going to be moving any money, and this is for all ages, if you're moving money from traditional IRA to Roth IRA, that's called a conversion, and you will owe taxes on that.
Talk to your tax advisor.
Talk to your tax advisor, always. When we're talking about taxes, just always talk to your tax advisor.
See if you can offset that with a charitable contribution.
Charitable contributions is one way that you can offset that tax. All right? So she's saying question mark. So watch back the live, Courtney, because we actually really described what a conversion was about 5 minutes ago. We went into it in detail, so watch it back. But just real quick, it's when you have retirement money in a traditional IRA and you move it to a Roth IRA so you won't owe taxes when you retire. Very simply put, that's what a conversion is. But when you convert, you will owe tax. And we went over it in more detail, and actually there's some videos on our YouTube channel about that too. So you can... and actually, I could even do a couple more to elaborate on that some more. Or message me. Anyway.
And then we talked about donating complex assets. Maybe, investment properties, LLPs, assets that you don't understand. Maybe they're causing a lot of work. Also, maybe assets that you don't want to give to your heirs because they don't want to deal with it. So that's a good thing to do, is to donate them to a charity and let them
if you have to get money out of your estate, if you're just sick of you don't understand it, it's just a good thing to consider giving to charity. A lot of people, I want you to consider giving, especially in this season. Consider giving that to charity, okay? Right. So let's look at giving that to charity, because you win, and then obviously the charities win as well. Right. And then finally was the QCD, the Qualified Charitable Distribution. So that's taking money out of your retirement accounts, taking money out of your IRA accounts. You owe taxes on that, right? So especially if you're over the age of 70 and a half, again, if you yourself are not over 70, anyone you know that's over 70 has to take money out of their retirement accounts, their IRA accounts, their 401k accounts, their SEP accounts. They have to take money out. The IRS forces you. So when you take that money out, if you directly transfer it from the IRA to your charity, you can talk to your tax accountant, but it's very likely that you can avoid your taxes on your required minimum distribution or your distribution from your IRA. If you gift it directly to the charity. Directly to the charity. So what's important about that is don't take it out first and then cut a check to the charity. It is a process. It's a thing. Right. Okay? So I would like to say today that this was a subject that someone had recommended to us. Right. We would love to have any recommendations or suggestions of things that you would like to hear about. Private message us, email us, go to our website, contact us, novawealthmanagement.com, and give us any subjects that you want to hear about, and we'll do it on a Finance Friday. But yeah, this was suggested to us about charitable giving. Right. Towards the end of the year, to get it in towards the end of the year. And I thought that was great because it applies to a lot of us that not only want to give and desire to give, but that are giving. Right. So there's different ways that you can do that. So if you have any questions, again, message us, novawealthmanagement.com. Follow us on Facebook, on Twitter. Like us on Facebook. Okay. Subscribe to YouTube, and we'll get you all the tips that we can. Thanks so much. Have an awesome weekend, and we'll see you next week. Oh, by the way, next week, we're either going to have a tax expert on next week, and she'll go over some specific. I want to interview her eventually, so it's just a matter of when we do it. But we're going to interview. Hopefully it'll be next week. Hopefully that will be next week. A tax expert to go over some of the tax changes in the bill, specifics, and then other ways to save before the end of the year. Right. And then we'll also have property and casualty. We're going to talk about getting ready for next flood season as well. So we're going to have a couple interviews coming up. After hurricane season ended, what we need to do to protect ourselves. I think a lot of people were really surprised what insurance covers and what it doesn't cover. Right. All right. Have an awesome weekend. Thanks so much for joining. Bye-bye. Bye.